Welcome to Mayer Brown's Global Financial Markets Podcast. Each 30-minute episode is designed to help listeners better understand the legal issues that impact their business given the ongoing uncertainties in the financial markets worldwide. Speakers from across Mayer Brown's practices and offices provide their timely insights on a wide range of topics, including finance, financial services, and insurance regulatory developments, securitizations, and litigation in the United States, the United Kingdom, Europe, and Asia. We hope you enjoy the program.
Hello, listeners. Our topic today is increased scrutiny of private equity ownership of insurers. And we will be focusing on current regulatory initiatives dealing with the role of private equity firms as owners of and investment managers for insurance companies. My name is Larry Hamilton, and I am a partner in the firm's Chicago office and the leader of Mayer Brown's U.S. Insurance Regulatory and Enforcement Group. My co-presenter today is also a member of our Insurance Regulatory and Enforcement Group, Sanjiv Tata, a partner in Mayer Brown's New York office. Turn it over to Sanjiv to start us off.
Thank you very much, Larry. So as Larry noted, today we're looking at scrutiny of private equity involvement in terms of actors in the insurance industry. And there's an element of deja vu to what we're discussing today, because while we're going to be discussing recent trends in the industry, these trends aren't entirely new. In the mid-2010s, the National Association of Insurance Commissioners, colloquially referred to as the NAIC, which is a coordinating body of U.S. state insurance regulators, reacted to several high-profile private equity acquisitions of insurance companies by adopting new guidance to be used by regulators when deciding whether to approve acquisitions of insurance companies. At the same time, the New York Department of Financial Services, which is state regulator for New York, which also has governance over insurance companies, reacted in a similar way. Fundamentally, the guidance that were issued by these two organizations at that time was designed to help regulators assess two vital pieces of information. Who is it that is trying to acquire control of an insurance company, and what are they planning to do with such companies once they control it? The guidance that was issued at that time includes examples of stipulations, both limited in time to the acquisition itself, as well as ongoing, that regulators could impose both when approving acquisitions and to be included in their ongoing surveillance of insurance companies. The guidance that we've seen in the 2010s is now being, to an extent, revisited by these organizations. Larry?
So why don't we start out by talking a little bit, thanks for that setting the table, Sanjeev, about what insurance companies and their investors are caring about the most. Well, insurance companies are in business generally to make money, and they do that in two basic ways. First, they underwrite risk, meaning that they decide what risks to accept and what premium to charge for accepting those risks, with the goal of earning underwriting income. But they also invest the premiums that they collect to earn an investment return. And my favorite story about that is when Warren Buffett was once asked why he buys insurance companies, because Berkshire Hathaway owns several. This is what he answered. I'm paraphrasing a bit. It's the float. People give me their premiums now, and I don't have to pay their claims until later. I may never have to pay claims, and in the meantime, I get to invest the premiums, and I keep the investment income. So if that's what insurance companies are about, what are the people who regulate insurance companies concerned about? And here, a point that it's important to make in the context of this podcast. But regulators of insurance companies don't care very much, honestly, about the folks who invest in insurance companies. And they don't care very much about those who sell investments to insurance companies. They have one constituency that they care about above all else, and that is the policyholders. Insurance companies make promises to policyholders, and the regulators see their job as making sure that the companies don't do anything that will jeopardize their ability to keep those promises. In fact, in insurance regulation, there's a whole separate system of accounting Insurance companies in the United States don't use GAAP accounting. They have something called statutory accounting, which is geared to insurance companies only. And as an illustration of the difference, I love this one. What do you call the difference between assets and liabilities in GAAP accounting? It's shareholders' equity, right? But what do you call it in insurance accounting, statutory accounting? The admitted assets, which are the assets that count for regulatory purposes, minus liabilities, not called shareholders' equity. There's no such thing as shareholders' equity in statutory accounting. It's called policyholders' surplus, illustrating the concept that from an insurance regulator's perspective, the net assets of the insurance company belong not to the shareholders, but they're held for the benefit of the policyholders. And what does this imply for regulation, Sanjiv?
So what we have here, looking at what Larry has just said, are two fundamental questions that regulators are looking at right now. And they're assessing whether the tools that they currently have are sufficient to monitor the risks associated with the questions we discussed earlier. Again, namely, who controls an insurance company and what are they going to do with that insurance company? So let's take these two questions or problems one after the other. When we're talking about control relationships for an insurance company, the traditional tool for regulators to monitor such control relationships is a requirement that a potential acquiring party of an insurance company file what's called a Form A application with the domestic state regulator of such company prior to consummating an acquisition. A Form A filing includes extensive information about the acquiring parties, including their financial history, their current operations, and their plans for the insurance company, with a particular emphasis on the future plans for the insurance company and what sort of projections are going to be associated with such plans. Control is presumed to exist if a person owns 10% or more of the voting securities of an insurance company, or of a person that controls the insurance company. And just to drill down on this point a little bit deeper, 10% threshold is tested at every ownership level in a chain of control. So that is to say, a person can own 10% of 10% of 10% of an insurance company. So 10% of two intermediate companies, which itself then owns 10% of an insurance company, and control would still be presumed to exist under the insurance laws of the various states. The current concern that regulators are looking at, which is why they're enhancing their scrutiny or looking into enhancing their scrutiny of private equity actors, are whether parties are finding ways to effectively control insurance companies without triggering Form A filings or otherwise circumventing the tools they have to monitor control of an insurance company. The second question that regulators are looking into are whether they have enough tools for identifying and monitoring transactions between an insurance company and its affiliates. And particularly, they're looking at whether transactions are occurring which are not on arm's length terms, such as services rendered above actual cost, which is effectively a dividend in size, whether investments are occurring in affiliates or purchased from affiliates that would not be considered to be objectively prudent, or whether conflicts of interest may otherwise arise, including just any sort of difficulty in enforcing an obligation against affiliate in a particularly troublesome transaction that the regulator wasn't able to stop. The traditional tool for monitoring affiliate transactions is a Form D advance notice to an insurance company's domestic regulator, which is followed by a 30-day waiting period. That is to say, affiliate transactions are normally required to be notified to an insurance regulator, and the regulator has 30 days to decide whether the transaction is appropriate. The current concern that regulators are facing are whether transactions are occurring that are effectively affiliate transactions, but are either not technically triggering Form D requirements, or are being treated as affiliate investments in statutory financial statements. So that's to say, whether transactions are occurring which are effectively affiliate transactions, but are somehow avoiding filing or reporting requirements that regulators normally impose on such transactions. Larry?
So the current initiative, how did it get started? The NAIC is a service organization for the 50 state regulators and the District of Columbia and other U.S. territories insurance regulators. Their goal is, especially in the area of financial regulation, to set standards and provide resources for the monitoring of insurance company solvency. In September of 2021, which is when this current initiative started, one of the staff of the NAIC, the director of their Capital Markets Bureau, made a presentation to one of the task forces within the NAIC called the Financial Stability Task Force, saying that there were novel regulatory risks of private equity owned insurers that he urged needed to be addressed. And I should say the Financial Stability Task Force is a subgroup of one of the large umbrella committees of the NAIC called the Financial Condition, or letter E committee. The letter E committee has 39 subgroups, of which this Financial Stability Task Force is one. That task force took this to heart, this request from the Capital Markets Bureau, and delegated to one of its working groups called the Macroprudential Working Group the task of following up on the concerns. And that group in December presented a document, December of 2021, a document that included 13 regulatory considerations that it believed related to private equity insurance, but not exclusive to private equity owned insurers either, that it needed to be addressed. And since that December meeting, there have been several rounds of comments. First, it was circulated for state insurance regulators to comment on it, and then for representatives of the insurance industry to comment on it, culminating in a final version that the Financial Stability Task Force and its Macroprudential Working Group adopted on June 27th of this year, and their parent committee, the Financial Condition, the letter E committee, adopted on July 21st, 2022. And that is now out there as a list of 13 considerations that the NAIC groups themselves have undertaken that they are going to address. And Sanjiv is going to lead us through how that is progressing.
Of course. So with respect to the current status of this initiative, at the August 12, 2022 meeting of the MWG, the chair of such group reviewed each of the 13 considerations, which Larry just noted in the regulatory considerations document, and in most cases referred each of these considerations and related commentaries out to another organ of the NAIC for further consideration, update, development in the process of discussing the status of each of these considerations. While no timelines have been provided with respect to the development of specific guidance as a result of these referrals, a tracking document has been posted to the NAIC's website to monitor the progress of these referrals as specific guidance is produced. At all times during the development and review of the document, the MWG has emphasized that most of these considerations are not limited just to private equity-owned insurers, but are applicable to any insurers that engage in the activities being described in these considerations. So let's talk a little bit about the specific considerations which we've been discussing. While we definitely suggest and encourage a review of the full list of 13 considerations, we're going to walk through key elements of some of these considerations and associated referrals. First, the Group Solvency Issues Working Group has been asked to consider whether adding additional disclosures to the forming acquisition process in order to more effectively address affiliation control structure and conflict of interest considerations that may not be captured in the current process would be helpful. So that's to say, the Group Solvency Issues Working Group has been asked to evaluate the Form A process to see if there are additional disclosures that should be baked into the process and to draw out some of these concerns, particularly around affiliation, control, and conflicts of interest. It should also be noted that the New York Department of Financial Services also recently issued a circular which noted that ownership of voting securities below the 10% threshold should not be considered a safe harbor that automatically negates control. So that is to say, even if you don't hold up to 10% of the voting securities of an insurance company, you may still be presumed to have control over such company and be subject to a state compliance and regulatory reporting regime. Next, the Risk-Focused Surveillance E-Working Group has been asked to consider enhanced surveillance of investment management agreements entered into by insurers and the process for requiring capital maintenance agreements from the insurance parent companies. Again, just to make ensure that affiliate transactions are not being used in order to raid these insurance companies or otherwise harm them. Third, the MWG noted that effective with the 2021 annual statements, which insurance companies are required to produce, a new Schedule Y, Part 3, requires disclosures of all persons who own more than 10% ownership in an insurance company, regardless of whether the ownership consists of voting securities and regardless of any disclaimers of affiliation. So just to quickly clarify that point, a Schedule Y is the organizational structure chart that's included in an annual statement describing the corporate family or corporate system of an insurance company, and now disclosures being required for that Schedule Y to include persons who only have economic interest in such persons, or if they have a disclaimer of affiliation in place, even if they own 10% of the voting securities of an insurer. A disclaimer of affiliation, just as a quick note, is a filing by which a person can disclaim control over an insurance company. So a more expansive read of the Schedule Y is now being required going forward to include persons who might otherwise not be considered to be controlling persons of an insurance company. Larry, would you like to take the next one?
Right. So another area where this macroprudential working group is exploring the private equity owned insurer issues is the work that's being done by two other units within that financial condition letter E committee, namely the Valuation of Securities Task Force, which is charged with overseeing credit quality of insurance company investments, and the Statutory Accounting Principles Working Group, which does, as its name implies, it sets up the governing rules for statutory accounting. And these initiatives that those other two groups are doing right now are covering many areas, but one of them is trying to increase the transparency of assets underlying structured investments by insurance companies, and to identify more precisely the role that affiliates of the insurance company may be playing in the structured investments. And insurance companies, life insurance companies particularly, have been increasingly utilizing structured investments in an effort to enhance yield, particularly at least up until recently, in the lower for longer interest rate environment, the desire to be able to achieve in a capital efficient way the higher yields. And so structured investments have become an important asset class for insurance companies, and that has raised among the regulators concerns about the transparency and what role affiliates of the insurance company might have in those investments. So think about this on two different dimensions. One is affiliate transactions, where an affiliate of the insurance company is the originator or sponsor, structurer of a structured investment. And that raises questions about whether they're dealing in arm's length and whether the investment is a prudent one for the insurance company. And then there are affiliate investments in the sense that the possibility of the insurance company actually being exposed to the credit risk or the investment risk of an affiliate. So if you take a securitization, for example, you could have an affiliate of the insurance company as the sponsor, and then you've got an affiliate transaction. Or you could have the underlying obligations of the securitization, including exposure to affiliate credit risk, and that both of those concern the insurance regulators. And it's one of the things that these other working groups are looking at, but the macroprudential working group has that on their list of 13 considerations that they are monitoring. And then another one is the question of how complex assets are evaluated from the standpoint of asset adequacy. And that is in the hands of a group called the Life Actuarial Task Force, which is working on a new guideline, asset adequacy actuarial guideline, to address complex and non-publicly traded assets, which are including but not exclusive to private equity connections. And they're focusing on this not entirely, but part of it in relation to the pension risk transfer transactions that we see nowadays, a very important type of transaction, PRT, they're often called, where a pension plan replaces its obligation to the the pension plan participants with an annuity, a group annuity that's purchased from a life insurance company, and the assets undergirding those transactions may in many cases be complex or non-publicly traded assets. So that's part of the scrutiny there. And then also another area that the Macroprudential Working Group is scrutinizing is the use by some insurance companies of offshore reinsurers, where the reinsurers that are affiliated reinsure the risks, often these annuity type risks that I mentioned earlier, and that can maximize capital efficiency from the standpoint of the insurance company. But the regulators are concerned that there may be reduction in reserves, there might be increase in investment risk, there may be complexities in the group structure. And so regulators have already been holding some confidential discussions with industry participants regarding the use of these offshore reinsurance and sidecar vehicles. Like, what are you doing with them? And do we have anything that we should be concerned about? And there may be further work coming out of this once the regulators develop a better understanding of what's actually happening. So Sanjiv, what is the future hold for all of what we've been discussing?
Of course. So the next meeting of the MWG and FSTF will be held on December 13th, 2022 as part of the NAIC fall national meeting. We can expect there to be further updates and further developments on the regulatory considerations document, which Mayor Brown will, of course, provide further updates on. But generally, I think going forward, we're going to see development in all these categories and increasing scrutiny and increasing development of tools that regulators are going to utilize to discuss and sort of control for the topics that we discussed today.
And actually, there is a tracking document at the website of the NAIC Macroprudential Working Group that they keep up to date with the 13 considerations and where each of them stands and where the ball is, in whose court the ball is currently. So that's a resource that you can look at. But of course, we'll be keeping our listeners and our friends up to date as well. Thank you, Sanjiv, for being part of this podcast with me, and thank you to our audience for listening. Listeners, if you have any questions about today's podcast or anything else relating to insurance regulation and its impact on global financial markets, please email us at GFM for Global Financial Markets, gfm@mayorbrown.com. Thanks again for listening.
We hope you enjoyed this program. You can subscribe on all major podcasting platforms. To learn about other Mayor Brown audio programming, visit mayorbrown.com/podcasts. Thanks for listening.